Hello, I'm Jonathan Moyes, Head of Investment Research at Wealth Club, and today I'm with Rupert West from Puma Investments to talk about the Puma VCTs. Hello Rupert, welcome back to the studio. So we're here to talk about two of the Puma VCTs, Puma 13 and Puma Alpha. For those who don't know, could you tell us more about them?
Absolutely. So our two growth VCTs are built to look for companies with real commercial traction out there in the market, driven by entrepreneurs who have a real focus at building sophisticated, well-structured, high governance businesses. We come in at the point where there's quite a lot going on. There's a lot of sales traction. They will have the start of some specialist function teams. If I look over the last 18 months, we're talking about businesses with 9 million revenue, about 75 staff, about 70% growth rate. So that's the type of business on average that we're getting involved with. And we come in and do a load of work with them, taking apart their data and using it to build as careful and precise a business plan as possible. And then we lead pretty substantial funding rounds into them to help them execute what is a plan with funding to deliver real strategic growth.
And for those who aren't familiar, Puma Investments and your role there.
So Puma Investments is the marketing face of Puma Capital Group, which is a business we set up 12 years ago. We've just touched $1 billion of retail AUM in our various different products. And we focus on venture and growth, which is the section of the business I lead. We do real estate lending, and we do a little bit of listed equities work, predominantly on AIM.
And on to the VCTs and where they invest. There are some VCTs that might describe themselves as a bit of a sector specialist. I think you're more of a stage specialist. Could you tell us a little bit more about that?
That's right. So we work across three different fields of business, three different broad sectors. We do some consumer brands, really when they've reached quite a meaningful scale. We do software and technology, and we do scalable business services. And we do that because we think it offers better protection and diversification, more meaningful diversification, to have not just many businesses, but businesses in those three different sectors. We specialize really in change. So businesses building a plan and executing that plan to transform themselves. And lots of scales and different sizes of businesses are pursuing transformation. But for us, the typical journey where we're coming in at 5 to 10 million revenue and coming out at 40 to 70 million revenue, that is a very radical period of transformation in terms of the size and scale and structure of the business and how decisions need to be made and cascaded down. And that's really the type of activity we really specialize in helping.
And is that part of the pitch when you're looking to win some of these deals, is that you've done this a number of times before, and I guess you can help the founders?
Yeah, it's completely right. I mean, our pitch to founders is firstly that we've done it ourselves. So Puma is a growth business in its own right, and we've scaled pretty successfully, but on that journey made lots and lots of mistakes. So we sort of communicate that to them as clearly as we can. Then we put them in touch with all of our portfolio who are of a similar stage going through similar journey, and they share those lessons. And then we have quite a large team and portfolio team who are there built to go and do these things and help these companies. And that's right from go-to-market to people and organizational structure and strategy and financials, which is really the flow of information about the business.
And we've seen recently some changes to the VCT rules, doubling of the limits, but a bit of a sting in the tail for a loss of some initial tax relief. Does that widen your investment universe? You're still looking for those scale-up companies, but maybe it gives you the opportunity to maybe back some of the winners a little bit more? Yeah,
certainly for us, given how we work and looking for these businesses with a bit more to work with, we are often up against the upper limits of what have been the limits, or we get there during our journey. So we will be able to continue to invest into our top performing companies for longer. So that is really phenomenally good, I think, for us and for our sort of risk profile. And often we do feel that we've done a great deal of work with businesses and got them to a point where they're now actually an incredibly appealing investment, and that's the point we can't continue. So that, I think, is pretty fantastic fit with how we work and our portfolio book.
And I guess that 10% loss, if you factor that in over, say, an average 10-year holding period, it might not be such a large impact. And
yeah, I think the relief change is obviously people need to think quite carefully about which VCT they're backing. Deployment's been a bit of a problem in the VCT market for the past couple of years, and only people who are backing bigger companies will be able to benefit from these rule changes. You know, if you do £1 million tickets, the fact that a company can ultimately take more doesn't do much for you. Whereas for us, that will actually have quite a transformational effect. But what you were saying there about our pitch to companies and the support we give actually chimes very well with entrepreneurs that we find. So we've been fortunately quite successful at winning deals that we liked and deploying capital in sort of on-mandate companies over the past year or so. So we're feeling pretty well invested, which is obviously good. But I think we pretty excited about what we can do the next year.
Good. So do you have any examples of companies you've backed recently?
Yes. So in fact, our most recent investment is a business that's a piece of middleware, and it sits inside e-commerce retailers who will sell you all of your Christmas presents that you've bought for all of your friends and family, and you've bought them online, and it comes to delivery, and there might be an option to pick up in store, an option to have delivered at home. Increasingly, this is a paid for option and no longer free unless you're buying quite a lot. And a third option to pick up at your convenience at a place near your home. Now that out of home delivery is delivered, the option to have that is delivered by HubBox, which is the company we've backed. And the reason we are very excited to come in at this point is HubBox has signed now with some of the major couriers working across Europe.
Luckily, we're now offering an alternative to home delivery, so you can collect your parcel from your local DPD pickup point, often less than a mile away, at a time and place that works for you. Just find a convenient pickup location and you can be sure your order will be there waiting for you.
The couriers will pay those retailers for the first year of use. So it's almost like they get a free trial of HubBox paid for by somebody else. So it's a very strong partnership sales dynamic, which could lead to a really strong flywheel effect. And we feel therefore lead to some great things for this business.
Oh, fantastic. Any other examples?
Yeah, so another business we've backed this year that's completely new to the portfolio is a company called Yaso. And this is in a sense related space, but this is taking developed Western brands and providing technology and infrastructure for them to sell into China, into the mainland market in China. And it does this on their social media channels that are a huge retail outlet over there. So things that we would think of like TikTok Shop, so sort of social media, short format videos with the opportunity to purchase through them. That is an enormous market in China, but it's one that's very difficult for Western brands to tackle, both because it's quite opaque, it's quite difficult. You need to have all your logistics set up in the right way. So Yaso provides a platform that just seamlessly does that, whilst giving back to the Western brand the type of quality and pace of information feedback that they'd be used to from their typical e-commerce channels. And it really, to date, their opportunity would have been, if they wanted to tackle China, either invest a huge amount really doing it themselves, or hand some money and stock to a distributor and kind of hope for the best. And this is a nice new option that saves them from doing that.
Good. And so turning to maybe some of the more mature investments within the portfolio, maybe someone like Influencer. How's Influencer performing? Largest holding, I believe, still at the time of recording.
So Influencer is performing fantastically well, and this is a business that's now between the UK, the US, Germany, and some growth in other European markets and in the Middle East. So it's a company that's performing well in a market that is still growing very strongly, where there are some big aggregators trying to buy up that specialist skill. So Influencer is a business that is still, after these many years with us, posting 30 to 40% annual growth. It is highly profitable, and it's really putting that profit, continuing to put that into its ongoing scale. And the pace of growth and the success in the US is really quite impressive, to the point where the US, where the business launched only 2 years ago, now accounts for about half of the revenue.
Oh, really? Wow. And so I guess the ultimate goal there is to generate some exits. Any recent exits you can talk about? Any exits on the horizon, Rupert?
So we're exploring the market in a lot of our sectors at the moment. We're finding that things are still moving quite slowly, and processes are just taking a long time to generate any sort of real pace and momentum. So it's still a challenging market, but it is a market that we feel it's possible to get things done in, provided you've given yourself time and runway and can do it in an orderly fashion. So we're pretty cautiously optimistic about next year as an exit climate.
Good. And so turning to risks, how would you describe the risks within your two VCTs and sort of compared to peers?
So we see our job as controlling risk for any level of return we're able to deliver. So we do spend a lot of time looking to mitigate that. We do that through diligence and portfolio support and having a big team. We are backing here smallish businesses. Obviously, we are trying to back businesses that are well run, and we're putting a lot of diligence and attention. But actually, I think these rule changes have a really interesting interplay with that, in that this particular period of fundraising, money raised now will be deployed under new rules, but the tax reliefs available are the reliefs of the old rules. So that's quite an interesting opportunity for people to explore. Managers will have to get used to the new rules and see what that leads to in the UK funding climate, and there will be some changes which we will have to try to exploit as best we can.
So you might be going back into your portfolio, perhaps calling up Lucky Saint and some of the others to...
So Lucky Saint is a great example of a business that had actually taken all of the qualifying money it would have been able to take. It's a business that's still growing very strongly, has some clear areas where it could put extra investment. It's growing well on the on-trade, so inside pubs, but that's a field that takes a lot of support. You've got to have a team of reps. You've got to be able to compete with big distributors and brewers. So that is a company where I wouldn't be surprised if there's an opportunity to put something together.
For those who are looking to back a VCT this year and perhaps looking to back maybe a few more than they would have done previously, given the rule changes, why should they be looking at the Puma VCTs?
So the Puma VCTs have always focused on scale-up businesses, very consistent messaging, and because of that, we don't need to change what we're saying to the market, to the companies that we try to source at all. All of that message is the same, is consistent, is long-standing, and has been working. We've attracted a lot of companies this year, companies we feel very confident about. We've built a big team at Puma, and we support those companies with as much effort and energy as we feel it's possible to do. So we feel that proposition over time will lead to good returns for our investors.
Well, Rupert West of Puma Investments, thank you very much. If you're watching on YouTube, please press like and subscribe to the channel for more.